Good morning. My name is John with the Pine Tree. I have the great pleasure of being here with Corey Burnell. Thank you.
Thank you, John.
Now, these are one of these little pieces where we want to showcase a local business that has some really nice expertise in our rural environment. I think because we're in a fairly rural area, but there's some pretty smart people around here. I think.
Not
me.
included,
Yeah,
company not included, right?
But this is. Now, tell us a little bit about your firm. Tell us a little bit what you do.
Well, the name of my firm is Burnell Wealth Management, and I'm located in Valley Springs. I used to work for Bank of Lodi for a number of years.
Got it.
Then when Wells Fargo acquired Bank of Lodi, I started my own practice. And what my firm does is it manages investments for clients who either are trying to accumulate wealth or already have done so and are now in retirement, taking distributions off that wealth. And we do some unique things that aren't found at other firms. Generally. Unique approaches.
In today's economic environment right now, do you supply aspirin with? Is
Yeah.
that one of the?
Yeah, aspirin, and for those who drink whiskey.
Okay,
right? Yeah.
got it. There we go.
But yeah, this is definitely a disconcerting time for people, very trying times, and the levels of uncertainty that I see from clients require a lot of attention and really a high level of expertise to explain what is going on and what do we do from here.
And I guess in the midst of the uncertainty, though, is if people keep a level head and go forward, I'm sure there's some really good opportunities as far as, and there's some. Somebody's going to make a lot of money in this environment. If it's played well, is that?
Yeah, that's a great point, John. Times like this present profit opportunities. Warren Buffett, the greatest investor of all time, has talked about he wants to be buying when there's blood in the streets, when people think he's crazy. So this time does certainly offer opportunity despite, and really that's caused because other people are acting fearfully and irrationally.
Right. So what in this, what should people do, to bring some of that wealth back to Calaveras County here in this? No, just joking a little bit. What do you see in this? What's some good advice for people right now?
Well, obviously people are concerned at this point about how do I not lose any more.
Right.
And so at this point we've seen the markets come off 500, 600, 700 points in a day on the Dow. Very fearful times, and that level, that rate of decline is not sustainable. We might get a short-term rally, so the idea is don't panic just yet. But we might be in for further decline should the global economic situation continue to deteriorate, should central banks' solutions not work. So the key is to take an opportunity when it presents itself to reallocate, to not lose any more, but also be put in a position to profit should we have either return to normalcy if the central banking approaches do work, or to actually be in a position to profit if the economic calamity does get worse. There are things that can be done there too.
Now, can you position clients on basically either way to kind of minimize, if it's to kind of hedge their bets?
Absolutely. Some things that are very traditionally used would be the metals, the precious metals. Should we have a return to normalcy, we should see the mining company stocks increase. Should we have continued calamity, we should see metals prices go through the roof. So a diversified metals fund is one solution, but a very unique solution would be an inverse treasury fund, because treasury bond prices are extremely high right now, far too high. People are receiving a negative real rate of return on the interest that they're earning on treasuries. So in a return to normalcy, treasury bond prices should fall. Or if the calamity gets worse here, it's going to come down on the creditworthiness of the United States Treasury, which has been acting very irresponsibly, and Treasury bond prices will fall there. So I think that's the best risk-reward trade in the marketplace right now, is to bet against long-term Treasury bonds.
Do you think we're close to the bottom, so to speak, or do you think I guess everybody's been probing for that mythical, what's your read on stuff now?
That is very hard to call, because we'd be well below a bottom right now if the private sector market participants would be put their cash to work. But the level of uncertainty in the global economic environment is causing institutional investors to hold on to their
That's
cash.
what you were mentioning. I guess everybody, a lot of you have taken their ball and gone home, so to
That's
speak.
right.
Is that what you were? Yeah.
Yeah, and if the private sector will not put its cash to work, then the only player out there is the Federal Reserve and the other central banks, and they can't make growth happen. The investors have to come back to both the corporate bond market, the municipal bond market, and the stock market. And if they won't put their cash to work, then we're not at any kind of a long-term bottom yet.
Right.
Now we might see a short-term rally, a little bit of because as I mentioned earlier, the rate of decline on the stock market we've seen in recent weeks, that's unsustainable.
Right.
You can't go down 5, 6,
Right.
7% every day.
No. Yeah. No, I guess a couple little indicators that I'm not. So this is way out of my depth as far as understanding all. But I mean, if people hear the terms like the LIBOR. Now that has been one that I guess I've heard indications that rate is still an indicator that's really high. I mean, tell us. I mean, was that one an indicator to where the banks don't want to lend to each other? Is that the liquidity?
That's exactly right. LIBOR stands for the London Interbank Offering Rate.
Okay.
And the problem with banks right now they don't trust anybody. They not only won't trust you if you go get a car loan, they don't trust each other.
Right.
And so they won't lend to each other, and that sends the cost of borrowing between banks much higher. That dries up lending to the whole financial system.
Is that one of the cruxes where everybody talks? I mean, you hear all the buzz stuff out there about just liquidity. Is that one of the indicators of it right now?
Yeah, that's been talked about for about a year now,
Yeah.
right? Since
Yeah.
the subprime crisis began. And the Federal Reserve and other central banks have done everything they can to, it seems, they're even doing things they should
Right.
be doing
Right.
to cause liquidity to go into the system. The problem is that if the banks won't play the same game, they won't participate, then the central banks are having a real problem. And now you see the central bank going around the banks. The Federal Reserve is now going directly to the corporate paper market, the short-term commercial paper market, and buying that stuff up itself. Where it gets the constitutional authority to do so, I don't know.
Okay.
But that's what they're doing.
But I guess so lay people can understand so if the bank is dumping the money into the market that is available for the actual banking institute, I mean the Federal Reserve is dumping it into the market for the banks. If the banks won't lend to each other, it still doesn't matter.
That's right.
The fact that they're available, but if they won't lend to each other, then the game doesn't.
Yeah, or lend to us.
Okay.
Yeah, that's basically it. It's as if this money, it gets to the banks, but their balance sheets are in such disarray, and they don't trust other banks' balance sheets, so the money just it stops there.
So it just basically it doesn't go. I mean,
Yeah.
they make it available, but
yeah, it hasn't helped, and that's been part of the frustration, I think, probably coming from Bernanke and Paulson. Why the $700 billion bailout then followed, because none of their other typical tools were happening. So they said, well, okay, we need to fix bank balance sheets, and we'll do that by buying up $700 billion, what's going to amount to now $1 trillion of bad mortgage debt off of the balance sheets of these banks.
on the bailout per se, I mean, there's been both the sides that say this is the worst thing that the government could do, and the other ones say that yeah, it's the worst thing, but it might work. I mean, is either of those? I mean, is that the accurate thing to where if they hold these assets long enough, then the government may actually be okay as far as getting a return on them, or not?
You know that I find that argument a bit laughing.
Okay.
Because if these assets really were going to have some kind of profit potential for taxpayers at some point in the future, then why was no one in the private sector willing to buy these assets?
Somebody else would have bought them already.
Exactly.
Okay.
So the private sectors looked at these assets and said the risk is far too high. So the federal government, if it does buy those assets, well, what's it going to do? Either buy them for the 10 cents on the dollar that they might be trading at, or is it going to overpay 50 cents on the dollar for them, in which case it will have losses.
But aren't they buying stuff that at some point has physical, like homes and everything else behind it? I mean, isn't it? I mean, at some point on some of these these real estate funds, aren't they actually buying
good
physical
question.
stuff or not?
Very good question. What they're buying is mortgages, and let's say that the mortgage is $400,000, but now the home value is $300,000.
Right.
If that person walks away from the mortgage, the Fed's left, the government's left with that loss, that $100,000 loss difference, you know,
Right.
that loss on the mortgage. So there are massive losses. When you talk about Freddie and Fannie,
Yeah.
all
Yeah.
of these mortgage debts that the federal government has now nationalized, sure, there are some assets backing those mortgage debts, but really let's say 20% maybe of those disappear due to losses.
Mhm.
You're looking at trillions of dollars there,
Right.
$1, 2, $3 trillion dollars.
That
By the
adds
time
up
this is
after
all
a
said.
long- after a while, yeah.
Well, yeah, look at our federal government's fiscal situation already. I mean, I don't know where we keep getting trillions of dollars. We just keep printing
They
it,
just
I
keep
guess.
printing them. Well, thank you. Thanks for sitting there. And now, I guess to wrap it up, I mean, what do you think? You know, if somebody's looking at this, even, I mean, what should they do? I mean, is it don't panic? Don't? Is it what's the?
Yeah, that really is what this is all about, and what matters is now that macroeconomic environment is nice to know about, but what do we do
Right.
in this situation to protect ourselves?
Mm-hmm.
There are some reallocations that people should look at. The two fundamental rules I tell people is have assets that are things people need,
Mm-hmm.
what I might call stuff.
Mm-hmm.
Don't be speculating, don't be investing in things that, well, you're hoping that it might come to fruition.
Right.
So
Right.
own stuff, and then the other thing is own things that produce predictable income. If you can do those two things, you know that that income is sound and going to be coming in. You can weather the storm because you've got the income, or you also own stuff that people will always need. Things not to do, don't go with a mattress strategy. If you stick your money under the mattress, the problem is that as all these dollars the federal government's been printing, as those eventually come into the marketplace and get spent, we'll see
Inflation
rapid
starts,
inflation, and you'll
Yeah.
lose purchasing power on your
Yeah.
money.
And I guess one little thing is we want to say on a little bit of a local level is that, you know, all of our little local economy is based on businesses and local people continuing to spend money and patronize the local businesses. You know, it's one of those things where, you know, some of this stuff is psychological too. You know, I mean, you know, that so we don't want to participate in the local contraction. We want to keep.
That's a good point, because these local businesses might think that this macroeconomic collapse could harm them.
Right.
They might refrain from hiring a new employee
Right.
or buying a new truck or
Mhm.
whatever the case is. I would say that every business owner should be very particular about the type of business they're in and how
Oh, right.
these things might
Right.
affect them.
Right.
But you know, we are in a rural environment that
Mhm.
generally will withstand economic slowdowns better than urban settings where people tend to spend more money than they make.
Right.
Here, people, I think, I have a sense that people live within their means a bit more than in other parts of the country. And that means they've got savings and they can continue to function and purchase the
Right.
things they need. And that's why, you know, be invested in things that people need to have, because they'll use their money to get those things, whereas they might not use their money to add on to their house or upgrade their car or upgrade a laptop or a cell phone or something like that.
Thank you very much.
You're welcome, John.
Appreciate it.
Yeah.
Thank you. Thank you.